You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music can mean only one thing. It is Thursday. It is 1:30 p.m. Central, 2:30 p.m. Eastern. It is time to get into the funkier side of the trading markets, and I do mean that literally this week. Yes, it is time for Twifo This Week in Futures Options. We have a lot of interesting stuff to parse. I think you all pretty much have one commodity on the brain this week. I'm hard-pressed to think of any other time in the history even of this program where we've had so much mind share, interest, demand for conversation about one particular product. So we're going to get to that in a little bit. Of course, so excited. Forgot to introduce myself. My name is Mark Longo, of course, from theoptionsinsider.com, as well as from this fine network. Make sure if you like what you're hearing here on the network, not just for Twifo, but all of the many programs we're producing these days, make sure you head on out to your platform of choice. However you listen, live after the fact, over there on two cans strung together with string over there in the Azores. However you're listening these days, make sure you leave a nice review on that platform so other folks can continue to discover the fun that is the options. At least we think it's fun. All right, let's move on in to see what's cooking here and who's joining me to help me break down all of this cooking. First off, our old friend, my partner in crime here, Mr. Sean Smith, the Managing Director of Derivatives Licensing over there at FTSE Russell. Mr. Smith, welcome back to Twifo in the somewhat historic times, sir.
Good afternoon. It's great to be on the show, and thanks for having me, Mark. Looking forward to an extremely volatile conversation.
It's a volatile. We're going to be very, very dark and sticky. All sorts of puns we could throw around out there for this one today here. And also joining me, by the way, I should mention You guys, as always, can find the home game, play along, generate your own reports. And you probably want to generate some crude reports right now. CMEgroup.com/Twifo is the place to go. I did reach out to CME, wanted to get them on the show to break down all of the madness that is going on out there across the broad spectrum of their futures and their options right now, negative strikes, all kinds of crazy. What goes into this? How are they listing? What's going on behind the scenes? I wanted to get you all of that. Obviously, understandably, they're pretty busy over there, but I'm going to get them on soon again so we could break down exactly how all this went down behind the scenes and what's happening over there from this historic week out there in crude. So we'll get them on. In the meantime, holding down the old CME Group hot seat today, our old friend, Mr. Russell Rhoads, the Director of Derivatives Research over there at EQ Derivatives. The man is very thankful he didn't spend 22 cents for that front month WTI contract. Mr. Rhoads, welcome back to Twifo, sir.
That's a true story. I was on earlier this week with you, and we were talking about that. And for the black, sticky kind of wet stuff that was 22 cents a barrel for a moment, I had the thought, how much lower can it go? And it turns out it can go negative, and we will talk about that shortly.
Yes, turns out it can. I think that was a rude awakening. I was joking on our last show. We had a prescient listener in our audience on the option block who was inquiring about negative prices in the WTI, and we thought, that's something that's theoretically possible. Obviously, we've heard of things like these crazy distortions we're seeing now, and never see it actually coming to fruition. But that's where we are. But I digress. We're getting ahead of ourselves. Let's step back and talk about the week that was. Indeed, it's going to be pretty much mostly about crude this week, as you might imagine, listeners. I can't remember really another time. You probably have to go back to the days of the late 70s when folks were lined up there trying to get gas and people had this much crude on the brain, but for completely the diametrically opposed reason. Not because it's too expensive, because it is indeed negative. They're paying you to take it away. Remember last show, listeners, we were talking, we were just coming on the heels of that historic cut in production out there for OPEC, around 10 million barrels a day. Folks were kind of hemming and hawing, saying, I don't know if they could even maintain this. Yet this is the largest cut we've ever seen. Is this even feasible? And then, of course, the numbers come out of the IEA saying that's not going to be enough. They're estimating demand annihilation as a result of this pandemic. No one's driving. No planes are flying out there. The demand is in the toilet. And so they're estimating the demand annihilation somewhere closer to 30 million barrels a day. So 10 million, 30 million. I don't care if you skipped out of most of Econ 101, you can see how that graph doesn't really line up. And so people were fading it even last week. We talked about it many times. That's been our drumbeat since the beginning of this year, is effectively all the shocks we've seen, the assassination of the Iranian general, the lingering specter of the pandemic, the end of the trade war, all these other things. They were fading it every time. The drone attack last year in Saudi Arabia, they faded every blip of upside they could get out here in WTI, and that at least so far has seemed to be the prescient move out here, because this week we all realized, and again, we had heard about it in obscure, theoretical tracks out there in research papers and the dismal science. This could possibly happen, but it wasn't a scenario anyone really anticipated happening. We saw that front month May contract getting crushed. Even folks like Russell getting perhaps lured to the dark side when it got south of $1, saying, well, what the heck? It's a lottery ticket, right? 20 cents, 50 cents, whatever. Roll the bones, and see what happens. And then lo and behold, it broke the zero handle. Just a very unwelcome surprise, I'm sure, for a lot of people. I think when all the dust has settled from this, we're going to hear a lot of analysis of certainly firms going out in this. We saw brokers taking hits. We'll get to that in a little bit as well. Going negative is not a boon for, the fact that no one can even go out there and take advantage of it, even in the broad public right now. You can't really drive, or all the other places where you might see this impact in your wallet. You can't even do that. So it's kind of a bit of a worst case scenario out here. Of course, all this caused by the massive demand annihilation. As a result, they have to store this crude or effectively turn off their wells. And turning off their wells, not an easy prospect, a bit of a dicey prospect. Turn it off. Might be hard to get it going again. That costs you money as well. So either way, these producers are faced with kind of a pretty bad choice. They could have to pay exorbitant rates for storage, or they could have to shut off their wells. So they took the opportunity. They did not want to take delivery. They did not want to have to get any of this crude, have to store it, or anything. So they were crushing that front month. And then when the costs were still there, they hit it further and got it down to negative, down to about minus $40 a barrel or so at one point, which is just saying that out loud. Just kind of, it's still kind of hard to fathom out there. Some great charts. I'm looking at what Wall Street Journal put this out. Others, just the chart of crude over just the past few days out there, and once it hits that minus 40 strike, it's just it's insanity. Of course, the madness of volatility took off. We talked many times about OIV out here, which is the crude oil VIX. That thing just exploded to the point of ridiculousness because once it goes negative, that formula not really designed to deal with negatives out there. Mr. RHOADS can get into that. He used to hang his hat in the VIX shop for quite a while out there and a little bit as well. Of course, today, a little bit of a different story. We're seeing the warm turning a little bit. We're seeing rumors of a little bit of more tensions between us and Iran. That's given a little bit of love to the futures out there coming in. They had been up about 75% from the lows on Monday. Of course, net on the week right now, WTI is at about a 16 and a quarter. So that puts it off, about a third or so from where it was. That's just this week. That's not even from last show out here. Great chart. I'm trying to see where this is from Deutsche Bank. They tweeted out 150 years of oil history in one chart. They quoted that out in nominal price dollars as well as real U.S. dollar terms. The price of oil going back to 1870. And pretty much however you cut it, because it wasn't negative back then, the price of oil earlier this week was cheaper than it was back in 1870. It's just, these are the times that we live in, the old times, the old Chinese proverb, the curse of may you live in interesting times. We are certainly living in those right now. I'll get into all the madness in USO in a second, but first, and we'll get a bunch of your questions. I know you got them all as well. But first, let's start with you, Sean. I'm curious. You spend your days obviously interacting with the equity market makers, the trading of the end users. Obviously, their attention has been focused on this as well. How much of your calls, how much of your conversation, how much even for you these days has been driven around and is just geared around just the madness that is crude oil right now, Sean?
I'm using that mute button just to be, conscientious because there's background noises here all the time. But you're right, Mark. Lots of conversations about the markets, lots of conversations about volatility in the markets, lots of conversations about my favorite subject, small caps, but being dwarfed by what's going on in the energy world right now and crude, and it has really consumed the discussions everywhere. But it's also the reaction of crude to the equity markets as well. And we've been crazy busy on the equity side. As you very well know, you see the numbers in terms of volume and open interest, and the numbers are up, right? There's higher volumes in equities. There's stronger open interest, which is a really good sign of confidence from the investment community buying and holding position, whether it be long or short in the futures, but also in options positions has grown as well. So it's an exciting time, but crude is we usually go through winners and losers, the positives and the negatives of this market. It's all crude. So I have no issue with there being much of the focus there today. But I do have to say that there was a pretty cool article in Barron's this past weekend about small caps. I just have to bring it up, and that and it's a topic that I have brought up myself in several of our conversations, and that is that as small caps are more volatile and swing to the downside, when the economy turns around, they outperform. And there was a nice little blurb in Barron's about just that, and how that the underperformer could be I think they called it the lagger in the article, could be the leader as the market turns. So just something to think about in all of this world of trading derivatives and futures, and keep your eyes on that Russell 2000 future, because it's a tradable liquid product. So back to you, Mark.
That's a good point. Russell 2000 has led the market, we said before, to the downside and to the upside multiple times, and it doesn't surprise me that it could do so yet again. And there's a lot to unpack there I want to get into equities as a second. Of course, as you mentioned, Sean, if you haven't figured out by now, listeners, we are dispensing with our usual format here. Usually we do the movers and the shakers, the light side and the dark side. There's really only one mover and shaker everyone's fixated on. And you got a bunch of questions about that. We'll get all that in a little bit as well as the impact on some of the other products you guys trade, like USO. But let's first toss it over to the land of derivatives research. Mr. Rhodes, I think even for you, who usually hangs your hat on equity vol, this has been just a moment that has fixated your gaze over here on WTI and crude oil as well. What's been going on? What's been lighting up your tape? Is this, aside from narrowly dodging a bullet earlier this week, in terms of what's been going on your side of the fence, sir?
Well, first off, I'm gonna coattail on my buddy Sean a little bit and just point one other thing out about small caps right now and the Russell 2000 relative to the I'm just going to say the name, the S&P 500. The Russell 2000 has a lower weighting in energy, and the Russell 2000, the number one sector in the Russell 2000 weighting wise is healthcare. So, which you got to figure that the healthcare, that's an industry to be involved in right now, and energy is something that you want to avoid. So, beyond the normal rebound that we see where we're typically led higher by small caps, I think in what appears to be this rebound, which continues to keep going, the sector breakdown that is more favorable for the Russell 2000 as well. So I had to coattail on that one real quick because I had been doing some work on sector breakdowns before all this.
Great point.
So there you go. All right.
Since you're talking so much Russell 2000, let's get to it now, and then we'll dive into the madness that is going on in all things WTI and everything else as well. But there is a lot, you said, going on in small cap land. Coming into Showtime, we saw our old friend, let's see, obviously it's going to wait 5 seconds, it's going to move quite a bit. But coming into Showtime, the VIX was at a 39.5, it's up about a handle from that now, about a 49.5 or so now, which puts it down pretty much about a half, almost unched from where it was this time last year. It was right around a 41 this time last week here. So not a lot of net movement on the vol side out there. But hey, that's what we see out there when all this turbulence comes back in over the weekend and on Monday. Then it's going to give the vol a little bit of lift. It was starting to come off, coming back up now. Our old friend VVIX, the volatility of volatility, that has come off quite a bit. That's down about 15.5 handles from last show. So volatility itself is less volatile. Which should make some sense given what we're seeing out there in the broad indices. But still, by no means is it quiet. Still around a 120 is usually in a normal scenario where we say, hey, this is crazy elevated. So it's still at the crazy elevated level. It's just not at the absurd levels of 160 and plus and north that it got to not too long ago. And our old friend RVX, a.k.a. the VIX of the Russell 2000, that one is at about a 46. That puts it down quite a bit, down about 9.5 handles out there, which means that spread has come in quite a bit. That spread was at about 6.5 handles at the start of the show out there right now, and let's say about 5.5 handles right now. So it's much tighter. It was about 13 or 14 out there coming in to Showtime out there. So a lot of madness happening out there in small caps. I do like that notion of, because people have been hitting us up saying, hey, I want to diversify out of these broad, large indices, and they have a lot of exposure to energy, as you might imagine. So that notion about how Russell 2000, a little bit less energy lurking around out there, might be interesting for a lot of folks out there who are just saying, I want to wash my hands of this stuff. I want to get out there. Certainly, of course, you're diversifying into a more volatile index, so be prepared for that. Every week it's on our movers and shakers, but still a lot of craziness. All right, that said, Mr. Rhodes, sir, a lot to unpack. What's been going on this week? What's been lighting up your tape?
Well, of course, we'll talk about oil now. It definitely has been lighting up my tape. I spent my whole day Monday digging around and trying to figure out, who's getting hurt here and also the why, because I will fully admit I did not know that this could go negative. I do know that CME Group was calling around to the risk departments of all their clearing firms and said, look, it can happen, so be prepared for it. So hats off to them for letting people know that this possibly could happen. I doubt a lot of people felt like minus 40 was going to be a place that we went with respect to oil. But, if there's nowhere to put it, and it's not like another commodity, back in the Dust Bowl days, if you couldn't sell your grain, you could just dump it off the side of the road. Or if you went to market and nobody was buying milk from you, you just dumped it out. And they literally did that because there was a disconnect in the economy. You can't do that with oil. If you try to dump it somewhere, it's going to end up costing you a lot more than $40 a barrel for the cleanup costs. So, we can see how that actually ended up happening. Also, I've been trying to get a lot of historical numbers around this. The open interest in this contract that just expired, which was the May contract, it was over 108,000 contracts coming into Monday.
It was a pretty sizable amount, more than you think for a negative 40 contract.
I don't know where that is relative to history. What I do know is I pulled up the COT data from the previous Tuesday and looked at the breakdown of where everybody was positioned. And it was kind of spread out across speculators and everything else. And of course, this is across all the different contracts. But the biggest position was short. It was like 36% of outstanding contracts last Tuesday, which was the last number we had, was producers hedging the cost. It was short positions by producers. And, it's very possible those are the ones that actually held it through expiration. And I think that may be why we're not hearing an awful lot about, people blowing up with the negative oil price, because it was, for lack of a better way to put it, a lot of the legitimate users that were involved in this. The only area that I heard that there might be some pain was one of the banks in China had created a structured product, and that structured product actually owned a bunch of the front month futures through expiration, maybe through negligence on their own part. And they're making their customers make good on owning a structured product that went negative for them.
Yeah, that's a poor choice on their part. Look, that's how these products have to live, right? They have to have that role. In fact, the other side, and we'll get into all the WTI options and fun in a second. In fact, maybe let's do that now, then we'll get into the USO side, because they are both kind of two different sides of the same coin right now. You can't really talk WTI without USO, and vice versa. But coming into right now, Showtime, by the way, cmegroup.com/Twifo listeners, click on the energy drop down, go to WTI. You probably want to check this one this week. There's a lot cooking out here. If you did that, you would see that, of course, they're at about 16 and a quarter out there on that contract, and that's off quite a bit since our last show, and even this week here. Of course, not quite as much as it was on the front month contract earlier this week, but again, I digress. Looking out here to the vol, obviously the vol is through the roof. Forgetting things like OIV and stuff for a second, because they tend to break down in moments like this. But the vol out here is looking like it's up about a nice 34 points or so over the course of this week. So that's quite a bit. That's a lot of vol just pouring in to these contracts out here. In terms of where people are trading this week on the options, it was June doing 64% of the paper out here. So people going out here to the next quarterly. That's where they want to hang their hat. They don't want to play in stuff in the weeklies expiring in a couple of weeks. They want to go straight out to June. So that's where they're hanging their hat. 64% of the paper. So 2/3. That's the most concentration we've seen in WTI options here in some time. Usually it's 30-odd%, maybe 40-odd%, maybe around half on a crazy week. But 64% is I can't remember seeing that much concentration in the past here on the show. And where was a lot of that paper? It was the 10 puts. The 10 puts were lighting it up pretty much all week. Monday, 11,500. Tuesday, about 17,000. Wednesday, kind of light, actually, at 3,200. And today, only 6,000. So the two big days of crazy plunging and terror, that's when they did the lion's share of this, about 38,000. We saw about 18,000 of it, or excuse me, 28,000 going up in those 2 days. So a lot of paper there on those 10 puts, followed hot on its heels by the 20 puts. As you might imagine, puts leading the dance out here. About 36,000 of those. The big day was Monday with about 20,000 of those bad boys as well. 9,000 on Tuesday. Kind of light the last couple of days. And today with it rallying, not a lot of love for the 20 puts out here as well. Those are actually still in the money puts. Whereas the 10 puts now, of course, given the rally, no longer negative, are now out of the money. Looking here to also saw some action on the 15 puts, 30,000 of those, 11,000 on Monday, about 10,000 on Tuesday. Not all puts all the time. I think the recent rally has helped some of the calls. About 20 calls, doing about 28, almost 29,000 contracts this week. The big day, actually Tuesday, not a little more than today. Today's still moving. I thought today would be a lot more, but we'll see. So about 10,000, almost 11,000 on Tuesday, 8,000 on Wednesday, and about 9,300 so far today. And again, most of these contracts are primarily opening across all these ones that I'm talking about here. So opening paper on a lot of this. Let's look really quickly out to the skew out here. It's been moving like a madman over the course of the past week. Just to give you some perspective, this June contract a week ago, the puts were about 33% bid to the at the money. So there was a lot of juice in those puts. Turns out that juice was warranted. They needed all the juice and then some. And like we said last show, there was no love for the calls last week. 6.8% cheap to the at the money. This week, the puts have come in, as you might imagine. We already saw that big explosion down to negative 40 and back up. So the puts are still rich, but a little less rich. They're only 13% rich this week compared to 33% coming in 20 points. The calls getting cheaper, actually, which is kind of interesting. 15.2% cheap to at the money. Last week, they were about 7%. So calls getting cheaper. You think this recent pull-up, the really recent bounce back would give a little bit more love to that call wing. Again, we are moving up it, so you might see it come in a little bit, but it's moving up so aggressively, you think the calls would maintain more of the bid than perhaps they are out here. So still no love overall net for the calls here in the June contract. Let's look really quickly and see a couple of the other contracts out here that we're trading. Let's go out to July. About the same deal out here. So, yeah, I mean, we're not going to see a call bid unless it really turns in the last couple of sessions, and it turns today out here. The call's still not bid out here. So, again, reflecting a little bit of long-term insecurity and what's going on out here in Crude. Speaking of insecurity, like I said, you can't talk WTI without talking about what's going on in USO. They are driving each other back and forth now. Of course, a lot of you listen to this show but have equities accounts, so you like to get your crude oil exposure through products like USO. We've said it in the past many times. These are Franken products. They are attempting to replicate a futures position using other means to do so. So whenever you're doing that, there's always going to be some friction. In the case of a product like USO or VXX in the vol space, there's going to be negative roll yield that's impacting you as well. So that's always been a problem. It doesn't track as well because it has that issue. And what USO always usually did, listeners, was it tried to maintain that exposure and that tracking of that front month WTI contract. And at a certain given date, it would roll to the next month and then kind of go on like there. And it was pretty much a done deal. Everyone knew what it was. They knew how it worked. And then all this madness started happening, and we saw USO starting to uncouple effectively. We saw comments recently out of CNBC that their chief marketing officer said, due to the extraordinary market conditions in the crude oil markets, including one of my favorite terms, super contango, USO has invested in other permitted investments as described in the prospectus. So let's break it down a little bit, because coming into earlier this week and last week, let's go into this week, they started tweaking it first by changing that so it wasn't all front month anymore. They added 20% exposure to the second month out contract. So that gave them a little bit more wiggle room. It did that for a couple of reasons. First off, USO was getting crazy popular. The AUM was exploding because as it kept getting cheaper, a lot of people, particularly retail, were flocking in saying, this thing is crazy cheap, I have to buy it. And so they needed to put that money to work somewhere. And they were hitting position limits in WTI. They could not own any more front month WTI futures. So they had to go beyond the front month. That's hence the 20% that they had of the second month, which at the time was the June contract out here. And let's see here, looking at actually no, that was June and then July. When this breakdown of positions in the NYMEX futures contracts out here was broken down at the time, they had roughly 25% of the total outstanding contracts was owned by WTI. It might even be more than that right now. That was just in the June contract alone. They owned 136,000 contracts out there, and then another 28,000 in other months That was the other 20% that they owned out there, and they were planned and they were scheduled to begin their roll on the 5th and conclude it on the 8th. Obviously, all that's gone haywire now, and so they started adjusting it yet again. The 20% was no longer sufficient. Then they had to come out and halt new issuances, so effectively it's trading almost like a closed-end fund now away from its NAV. And then on top of that now, because that 20% was not enough and they're hitting position limits there, they had to completely alter the structure. This is as of yesterday, as of Wednesday, the holdings in USO were now 20% June, 50% July, 20% August, and then 10% September. They've gone all the way out to September. Now, the downside of that is, of course, it's not going to track the front month contract that well anymore. But on the upside of that is you probably want to be a little bit farther out in the term structure right now to avoid some of the madness that's going on. They've also said they've abandoned that pre-announced roll structure, which right now probably a bit of a good thing. You know, that's a thing people, whenever you know ahead of time what a large player is going to do, they're going to fade you pretty aggressively. So the fact that they're going to be a little bit more perhaps nuanced with this, not perhaps the worst thing. There's a lot to unpack here. Obviously, Russell, going back to, your old stomping grounds in the vol space, and even for us here on the network, the analogy everyone's using right now is XIV. They're saying, USO's going to implode like another XIV. XIV is a little bit different story. Obviously, they were inverse. They were doing all kinds of crazy stuff. So when you're inverse like that, the sky is the limit for how much you could lose in a short period of time like that. USO doesn't have that same inverse quality to it. But still, it is one of these Franken products. So I'm curious to you, Russell, as you're looking at all these Herculean steps they're taking to really try to salvage this product. What are your thoughts on what's going on out there?
I think they're going to do a pretty good job of avoiding completely blowing it up. I think if it goes away, it's going to be because they choose to make it go away. They're just like, XIV could have survived what it went through. The folks behind it just decided to kind of wash their hands of it. They already weren't really thrilled with running it, it seemed. So that's what happened there. USO, I've watched it for a long time. And the reason I've kept a close eye on it is it's actually the instrument that the SIBOs, you talk about OIV on here, which I think is a much better volatility index than OVX. Yeah,
I usually don't throw out OVX for reasons like this.
Yeah, and you never did. I worked at the place where they came up with OVX, so I had to pay a little bit of attention to it. USO has done this before, where I've actually checked the holdings in the past, and they've gone over the counter in the past to get the exposure that they're supposed to get. And, and what I'm actually doing right now is I've got all the roll dates going back to 2016, and I'm going to take a look at what happened in the front and second month future when they went through the rolling process for the last 4 years and see if it looks like anybody was trading in front of it, if it added to the volatility, or if this is something that everybody has just discovered. I think the reason that they've got to switch it around now is because everybody and their mother is paying attention to it, not just people that pay a lot more closer attention to these types of products. Personally, I think it goes away, but I think it's going to go away because they don't want to deal with it anymore.
Interesting. So you think it's still going to go the way of the dodo? They're going to do all these Byzantine steps to preserve it?
I think they'll, and I haven't read through the prospectus, but typically there are ways that you can go about liquidating a fund if you choose to do so. And since this thing is continuing to wind down to zero, and typically when you get the price, and this is all assumptions. So I just want to preface that. I'm not saying that I've talked to anybody over there or know anything, but just watching something that has gotten down to a price of $2.62 and knowing that if you want something like that to survive, you're going to do a reverse split. The fact that you're not seeing a reverse split makes me think they're just happy to let this thing die on the vine in time.
Actually, I forgot to bring that up. They have announced a reverse split, 8-for-1.
Oh, they did?
I forgot to include that in my rundown. So they are doing a reverse split. So
can we back up?
The live shows.
That you know what? That actually that was kind of the core of my thesis right there. So maybe they're looking at a way to salvage this and keep the structure going on.
See, that was my thoughts as well. I was kind of, because you saw XIV and we saw that complete implosion of it, and you're right, that was the issuer kind of giving up on it a bit as well. They're saying we just don't want to deal with this hassle anymore. Let's let it all go out in the after hours and all. And they had some pressure on them from other players as well. It wasn't only their own call. What we're seeing here in USO, I don't get the same vibe from that. They are, because you look at steps you would take. You're right. If you wanted to salvage this thing, you would do pretty much exactly what they're doing. You would spread yourself out farther along the futures curve to protect yourself from some of this madness and go to contracts that are a little bit saner. You would stop disclosing your roll schedule for all and sunder to see. There's a lot of things that do. Now, of course, the reverse split. There are a lot of things that they're doing that show to me that they are in it to win it. They want to keep this thing afloat, and they have a thing that's exploding under AUM. People can't stop buying this thing. In fact, I'm looking at the numbers right now, even for a lot of the quote-unquote millennial-oriented brokers like Robinhood and SoFi out here, they're saying USO is far and away their most popular issue right now. It was the most bought stock on Robinhood, and by far, quote-unquote, the highest volume trade on SoFi Invest platform, with a 300% increase in volume they saw. Obviously, a lot of this is just price-driven. It's very cheap. We know Robinhood customers in general, pretty price-sensitive. They're trading not even in round lots. They're trading, a few shares here or there. So a cheap one already. It's a cheap flyer on this. You can see why it's getting attraction. So it seems like, again, we got some questions to this too. And by the way, going back to the negative here too, speaking of brokers, looks like the numbers coming out of IB, Interactive Brokers, they took a hit on this negative. This obviously not going to be the only ones. We're going to see more of these coming out in the days and weeks and months to come, listeners. Looks like they took an $88 million hit from some of their customers having positions on and not really knowing it could go negative out there. And when it hit minus 40 a barrel, that left IB on the hook to the tune of $88 million out there to cover their positions out there. So and we heard stories about CME going out and calling up brokers saying, hey, this can go negative. This can happen. Get ready for this. So seems like IB got caught up in all the madness out there. Speaking of the madness, you guys have questions. Let's get to them. They're all mostly Crude and USO. We got some other ones as well. Maybe we'll end on a happier note. But here, let's break it down here. Let's see how many we can get to. JLNE wants to know, how the heck can CL go negative? Well, I think we touched on that earlier in the show. We got this kind of insane scenario here where, of course, demand has been annihilated by a pandemic. We touched on our last show that demand annihilation was fueled, the price at least was fueled by this insane price war between OPEC and Russia. They wanted to squeeze out U.S. shale oil producers. They may have succeeded beyond their wildest dreams. I don't think anybody over there at Saudi Aramco thought they're going to be seeing crude dive into the negative. Yet that is the tail end. So you have to have this absurd set of conditions where you have a global pandemic annihilating demand, you have a price war fueling the sell-off to the downside there, and then on top of that, you have to have now these things where no demand can happen, so the storage has to be, these producers have to store it somewhere, the storage is filling up, so the cost to store it, the cost to ship it and everything else, or the cost of turning off your well are so much so that you have to sell that future even at a negative price. And so that's pretty much that's how you get with these physical commodities. And we were chatting about it on the option block recently. Can the stock go negative? And really, no. You don't have these same physical, logistical type distribution things. You don't have to ship your Apple shares off to a giant repository and pay to store them the way you do for physical commodities. So you have that added aspect. And if you can't stop producing, but you also can't take delivery and can't store it, then you have to have situations like this where it can go negative. Neil, do you think we'll see negative prices for the foreseeable future? Well, we're already out of the negative. Everyone knew once we got to the June contract, once that crazy May contract went away, we'd get out of it. The question was whether June would go negative. They hit it pretty quick, but now it's coming back on the heels of all this madness out of there in the Middle East. Of course, we've seen it happen once. We're in a world now. In fact, this is the next comment. I was just about to say this. We're in a world now, 45T $ mentioned this as well. So we're living in a world where there are actual negative strikes for crude options. Jesus, whoever would have thought we'd get there. Yeah, I was about to bring that up. On the 22nd, I believe, CME announced they were adding negative strikes to the options in WTI, so you can go out there and trade your options on the negative futures, which brought up questions on our last show. Does your delta go negative if it goes into the negative territory? All these other crazy things that are just insane out here for people to even consider. Pierce wants to know, but yeah, I'm with you, 45T. This is the notion that we would have listed negative strikes for crude oil. I didn't think we would get there, no. Is this really a crude black swan event? Pierce wants to know. People theoretically thought that crude could go negative. Isn't a black swan supposed to be completely unforeseeable? Well, Russell, you were saying even earlier this week you didn't think crude can go negative. So what do you have to say here for Pierce, as well as all these other crazy questions we've gotten so far here? Is this truly the crude black swan everyone's talking about, sir?
It might not be the black swan that they're talking about. I saw Terry Duffy on CNBC yesterday, and he didn't cite the example, but he said that we have had some negative commodity prices in the past. So if it is something that had happened in the past, if something happened in the past, but we all forgot about it, does that still make it a black swan? That's a pretty, I know I got you speechless there for a second.
That's your deep thoughts there. That's your deep thoughts there. That's what I get from muting myself, to be nice. But, you're right, because the technical definition of the black swan is this unforeseeable, unknown, right? And this is technically a known thing. It's not really a known unknown because we know about it, but it's a known danger. So I guess technically it's not, but just the sheer size of it, the sheer unprecedented nature of it, the sheer fact that it caught everybody off guard, including a lot of these brokers and others out there, shows that if it walks like a duck and it talks like a duck, then it's kind of a duck. In this case, a black swan. So I'm going to allow it. I'm going to say that this is indeed the crude black swan that everyone has been chiming in about here. Let's see, keep going. A lot of USO questions. Again, we don't usually talk to ETFs here, but you can't or the ETPs in this case, but you can't really disassociate USO from WTI right now. So Jan Peck wants to know, what is happening to USO? I think we touched on a lot of that. See earlier in the show there, Jan Peck, where we broke down the changes in the structure, how they're moving from the front month to first, second month, and then beyond, how they halted distributions, how they are doing, I believe it's an 8-for-1 reverse split. I think that's on the 28th. I'll have to check my dates on that. But that is coming up soon. So there's a lot going on out there. All right, Mr. Rhodes, interesting question. I have my thoughts. I'd be curious to hear your thoughts as well. Everyone's got this question. This one comes from T-Mal. A name sounds familiar. I think it's written in before. What do you think of USO at these levels? So you were just saying earlier you think, you thought, I should say, USO going the way of the dodo. Are you still there, or you think this is flyer territory? Are you perhaps going to put the kids' college fund? There you go.
I kept trying to unmute myself. Thanks for filling a little bit there. The fundamentals are not positive for oil. Yeah, it's a very, throw out the whole negative pricing and everything else that just happened. It's a very, very balanced market where we pull stuff out of the ground and it gets used within a week or two. And it's a constantly flowing thing. And when it's not getting used, everything starts to back up. And that has been what is happening here, is everything is getting backed up. And I think it's going to be a long time before the fundamentals and the economic fundamentals get right again for oil. Even if we all went back to work right now, I think it would be 3 or 4 months before we actually started to see some normalcy in oil pricing.
And since we're diving into so many questions, let's make it official with a little bit of your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's Mixlr.com.
All right, everybody, welcome to your segment, which we've already been doing, your futures options feedback. Just got to make it official there. We have a ton of more questions to get to, but I always like to say, if you're listening live, you ask questions, you get bumped to the head of the queue. So let's do that now, get some live questions coming in. Samuel P. Bowie, he said, just started tuning in. So check out the podcast later on, Samuel. You missed a lot at the beginning talking about negative WTI and all the fun with USO and everything. He wants to know, when do you see high debt U.S. shale producers start defaulting on loans? Well, we have already started seeing, not as many as we thought, but we have seen the early waves. I forgot when the date it was, and we saw the first one of these producers file Chapter 11 out there. So we have seen a wave of those. I haven't seen the news of them starting to default on the debt. But the Chapter 11, I think we all saw a lot of those coming in the near future. In fact, the conspiracy-minded, and there are a lot of those out there in the crude oil space in particular. I'm not sure what it is about crude that attracts the conspiracy-minded. But of course, the conspiracy was that this price war with OPEC was to drive out U.S. shale producers, which I think there's a lot of. That's pretty much a given fact at this point. But also that a lot of the large producers in the U.S. are going to kind of sit on their hands and not really urge a lot of, let's say, administration intervention and other things like that to help prop up these levels, because they wanted a lot of these smaller producers to start going the way of the dodo so they could gobble them up at pennies on the dollar out here. So that's another reason why we haven't seen some of the big players perhaps saying, hey, we need interventions, we need to really start defending these prices out here, or coming in and doing things for themselves, because they want these producers to go out as well. So a little bit of a two-pronged attack on the smaller shale producers out there. And we have started seeing the firsts of the Chapter 11 filings. I have to go check on the loans, the credit status. Mr. Rhodes, is this something you've been watching? Have you seen a lot of the smaller producers out here starting to file for Chapter 11, or, as Samuel P. Bowie asks, defaulting on their loans, sir?
I haven't, but I do know that if you take a look at the high yield market, you specifically take a look at there's an index out there that really just isolates the energy related high yield, basically the people that have issued bonds that would qualify as junk bond or a high yield bond. I know that the spread for those has widened out tremendously, which is an indication that a lot of people are concerned about that. I think you'd have to do a little bit more digging than I have to figure out exactly what names that might be impacting.
Here's another one I want to get to here, because this one has been given credence in a lot of big outlets, and I find it somewhat concerning that this would be the case. This one in particular question comes from MM87. He wants to know, did the USO roll cause this meltdown? I've seen some outlets that have actually reported just that, saying it was the roll that did this. And that kind of leaves me scratching my head, wondering if they really understand the mechanism of the roll that's going on. And also the schedule of how USO, it was a pretty well-defined, until now, it was a very well-defined schedule. And as of the time of that meltdown, USO was out of the front month. So that's why you didn't see USO melt down even worse than it did out there. So no, it wasn't a massive dumping of front month contracts by USO that caused this. Russell, have you been seeing this around as well? Are you as surprised as I am that this rumor is persisting out there?
It's driving me absolutely bonkers. And there's some really smart people that are repeating this, which really just makes my stomach cringe a little bit. But I know for a fact, because really I spent like all day Monday just looking around and I cited some numbers at the beginning of the show that the majority of the shorts were producers. Well, the USO, they have a defined schedule of when they roll. You can go to their site and you can see exactly when they rolled for the last 4 years. And they were out of the May contract as of April 13th. That's a week before this happened. They were out. So I don't think it was USO. When I hear of a Chinese bank putting together a structured product that got hit by this, that makes me wonder if it's a few more over-the-counter products that were created using these futures that maybe aren't even in the U.S., but I think we'll learn a little bit more about this. But I know for a fact, because it's not like I heard it from an authority. I did the legwork on my own, and I know for a fact that USO had no exposure to the May contract on the 20th. And they hadn't had for a week.
This is an easily debunkable thing. I'm not sure how it got so much steam. I don't get it.
Because while it was going on, there was a Forbes article, and a lot of people glommed onto that.
I guess, and that's what you get.
Or Fortune. I always get Forbes and Fortune.
Forbes and Fortune.
I think that's how it happened.
I get all your news from Zero Hedge. It's the only reliable source.
And one other little thing there is I actually think due to the isolation that we all have going on, if the smart energy person at Bloomberg ran around and told everybody exactly what's up and was able to do that in 3 minutes, I do think the environment that we're in, where we're all disconnected somewhat, probably is the reason that one persists. If we weren't all in quarantine, this wouldn't have happened in the first place. But I think I think the information flow in quarantine has something to do with it as well.
All right, next up we've got, just to debunk that again, it was not the roll. USO was out. Wait till the next. Of course, we don't know when the next roll is. That's part of the mystery now, which makes it kind of interesting out there in USO land. This guy Demanity. I like that. You might win handle of the day. I know Sean's paying attention. He likes his handles. We'll get to that in a second. Let's see. Demanity wants to know, is USO just another XIV now? I think we talked about that earlier in the show. XIV had other issues. It was an inverse product. That's the thing. Obviously, if you're short something, there's no ceiling on how high that could go. So there were other issues inherent in XIV that are not inherent in USO. But in general, and also we didn't see that issuer take the Byzantine steps to preserve it that the issuer here for USO is. So they're defending it. Maybe I'll go on record and say I don't think it's going to go the way of the dodo. Russell said earlier he did, but then he heard about the split, so he may be changing his vote out here. But I'm going to go out and say no. I think they're taking a lot of steps. I'm not saying it's going to be a great vehicle to invest in the near future, but I don't think it's going to go to zero. That said, that could be wrong. But hey, I'll go out there. I'll put it on a limb. I'll say, hey, they're fighting. They're fighting to see. What the heck is USO now? Is Bantam wants to know. Good question. Touched on that earlier in the show, too. Right now, effectively, it was about 20% front month, about 50% 2 months out. I think about another 20% a couple months out beyond that, and then 10% in September. But that's going to change day by day as well. So it's more of a broad spectrum, a more holistic view of the WTI term structure. They do mention, if you look in their prospectus as well, they can also trade OTC and swaps and a bunch of other things, too. So there's probably going to be some of that starting to flow in there as well. So the notion that it's just front month WTI anymore is no longer the case. Mr. Rhodes, that's why I like having you on. You're my director of research. As Bantam wants to know, what the heck is USO right now? What are its holdings right now, sir?
Okay, right now, and so they got a lot of cash and treasury bills, but we don't care about that. Right now, as of the beginning of the day, the holdings as the close yesterday, the biggest holding for USO, 20.69%, actually 23.76% of the fund. I'm messing up my percentages here. Actually, it looks like about 40% of the fund is in the July contracts. It looks like maybe 30% or so, and I'm doing some math in my head, is in the ICE WTI contract. They're split between NYMEX, which is the CME group one, and ICE.
They probably have to. They're hitting position limits everywhere, right?
The third biggest holding is the June WTI. They've already started buying some August WTI contracts. And then they've also got some July ICE WTI contracts. But you can go to their website. If you Google USO holdings, you can see what their holdings are. They still have a roll schedule on there, but they do have a statement that says we're not necessarily going to stick with that roll schedule. So, and apparently they haven't, because they've gone a little bit farther out here as well. But yeah, you can see from day to day what their holdings are. It's transparent.
Yeah, that shows how quickly it's changed, because just as of yesterday, it was 20% June, 50% July, 20% Aug, and 10% SEP. So it sounds like they've adjusted that, as you would expect, and added in, ICE and everything else as they need to keep gobbling up positions. One more here. This is what you were just talking about, Mr. Rhodes here. Then we'll get on some believe it or not, other questions out there besides crude oil. Thoughts on the 8-to-1 reverse split in USO? Mr. Rhodes, you didn't even know it was happening until earlier today. So now that you hear it, What are your thoughts? Are you reassured that perhaps USO won't go the way of the dodo, sir?
I think it is a wonderful thing that it is doing this to remain a viable product and allow individual investors to get somewhat direct exposure to oil. I think it's great that they're trying to salvage it, because there are only two funds out there like this, and it's one of the few ways that you can actually get exposure to oil if you're in an equity only account. So more power to them, and I think they're going to fix the problems, and we won't see the kind of issues that we've seen in the past. It looks like they're going to try to smooth out the roll a little bit more.
Hey, maybe people actually learned lessons from previous meltdowns like February of 2018. Go figure how refreshing that would be. It does seem like, the steps you would take to defend a product like this, it does seem like exactly what they're doing out there. So that gives me a little bit of hope that perhaps USO will live to fight another day. All right, let's get some other questions on out here. We could talk crude all day, but we have other stuff, and we'll end with some fun, happy stuff as well, just to make everyone get out on a happier note out here. Mr. Sean, you've been waiting patiently here. You were talking earlier about small caps and how crazy volatile they are, but also a little bit perhaps insulated from the world of energy. That said, JLC wants to know here, Sean, just a pretty straightforward question. Why the heck is RUT so volatile? So I will leave it to you, sir, as the specialist in Russell. Why the heck is RUT so volatile right now, sir?
Well, it comes down to the components, the weightings of those components within the index, and we got Russell Rhoads on the phone with us too, who can probably add some really fun color to these comments as well. But they're small caps, they're small companies. They usually have a product or two. They're not well diversified in their product suite, so their revenue streams are pretty straightforward. They're small companies. They're in a situation now with the coronavirus where a lot of these companies had to lay people off and borrow money. So headlines like small business administration loans being approved, or small business loans being held up within the Congress or Senate affect small caps directly. So you've got a heavy weight in financial stocks. So interest rates play a moving role within the small caps, the Russell 2000 in particular. So when the market swings to the downside, you get a bigger move in these small cap stocks. And as the market rallies, you sometimes and historically have outperformed to the upside as we come out of recessions. So you've got an index here, and I think a long time ago I called it a volatile gang of stocks, and you and I and a couple of listeners had some fun with that comment. But it is Russell 2000 is, because of its makeup and its weights of the various sectors, it's more volatile. And Russell, feel free to jump in on any and all, please.
No, you summed that up fairly well, because academically, you would think that a portfolio of there are about, 1,920 stocks in it right now. If that's a guess, I don't know. But a portfolio that really, I know that the number changes as we get closer to the reconstitution. But it's a lot more stocks than some of the other broad-based indexes. It's just there are a lot of it's got a higher consumer discretionary weighting, which can be, consumer discretionary things that you can put off buying when you're worried about the economy, or when you're not worried about the economy, you can step up and start buying a lot more, cars and big computers and all the really fancy stuff that we're holding off right now. There's a higher healthcare weighting, which actually is a volatile sector. It's a lot of domestic industrials, which again, they turn things on and turns things off based on what's going on in the overall economy. So I really feel like beyond having, beyond having the a lot more small stocks, I think the sectors add to that as well. So there
you go. So who was that asked at? JLC, ask and you shall receive. Out there as well. We got a lot of people chiming in now live with all sorts of questions. We are kind of coming up against it let's tell you what, we'll end on as a happier note, and all the other questions, we'll try to get them in maybe on other shows or other stuff like that, because we are kind of coming up against it here. Let's go to this one from Akmomo. I like the handle from, says, great show. Enjoy it a lot. Well, thank you, Akmomo. We enjoy you listening. So it's a whole enjoyment party going on here. He says, I agree that USO now has a larger futures window, WTI and crude, which is a good thing. Plus, according to their prospectus, they can invest in many instruments. You are correct. Their prospectus does give them the flexibility that maybe other products lack. They can do swaps. They can do other things. So there are a lot of sources they can go to try to tap that liquidity. And I got a feeling they're going to be tapping a lot of those sources as the funds keep flowing in to USO, as they need to get whatever they can. I'm sure they're talking to the regulators and others, too, about saying, hey, we're at these position limits. What can we do here? Because there's just so much coming in out there. There's so much to I'll tell you what, we'll go a little bit longer here, and then we'll because these are unprecedented times, so we'll keep everybody a little bit longer just because we love you guys here. MBOT, USO rolled because the index methodology is, or at least was, to sell near-term contracts to buy next-term contracts. They did not factor in the possibility of these extreme spreads between those contracts, which led to massive negative roll yield. They'll probably now change methodology to go further out the curve, but it's too late, in my opinion. Well, they did do that. They didn't exactly get caught up, like we talked about earlier. They didn't get caught up in the negative extremes that some people thought they did, including Forbes or Fortune or whoever it is who wrote that article. So, yeah, that was their methodology, and now it is no longer, which is probably a good thing given what's going on. If you want something that just tracks front month WTI, maybe not. But again, given the performance of front month WTI over the last few sessions, you probably don't want that either. All right. That music means we came up against it. Great questions. Keep them coming. We got so many more piling in here. We're not going to have a chance to get to them. We love you all. We'll get you on more shows. Maybe we'll do another Q&A show coming up here. But since I promised we'll end on something fun, something silly, let's do that as the music is playing out here. We asked you guys at the beginning of this week, let's just distract you from all this madness, negative roll yield, craziness, meltdowns, plagues, pandemics. Let's do something fun. We said, hey, there's a small sampling of films that are in the quote-unquote floor trading universe, but we put together a couple we think are the standouts. Which do you think is the best? We gave you 3 names. Quicksilver, which is a little-known Kevin Bacon Bike Messenger masterpiece. Rogue Trader, where Obi-Wan / Ewan McGregor plays a floor trader in, I believe, Singapore, Nick Leeson. And then, of course, Trading Places. We gave you those 3 choices. Sean, I know you like yourself a nice, silly thing. First off, what is your vote, if you have one? B, what do you think our audience is voting for? And then C, if our audience is interested in learning more about all the stuff you have cooking over there at FTSE, like the coronavirus hub and everything else, where should they go? What should they do?
You know, there's so many other good trading movies. I got to only pick from the 3. If
you have more, give me more. We want more. Give us more.
There's Wolf of Wall Street. There's is
that a trading floor movie, though? Is that really a trading floor?
Itself.
I mean, Wall Street is great. Wall Street is the best movie of all these by far, but it's not a trading floor movie, really, right?
Well, Trading Places has the trading floor, but, you got a trading floor scene in Ferris Bueller for crying out loud. So
that's what someone just brought up on our last show. Uncle Mike, he said there's a trading floor scene in Ferris Bueller, so that's why I love these polls. We remember things collectively that we had forgotten, sir.
I'll go with Trading Places just to stick within the confines of our agreed upon choices. So Trading Places. And back to Russell, as Russell Rhodes brought up, we've got Recon coming in June. Very exciting time. And folks are looking at the Russell 2000 index right now. So it's small caps is definitely the place to focus in these coming weeks and months. So keep your eye on there. And if you have any questions, you can just reach out to me personally at smith@FTSERussell.com. And I would just want to add thanks for having me on the show. And Russell, great to have you with us on the show as well. It's always great to reconnect with you.
Since his name is Russell, I think he's legally obligated to talk about the Russell 2000 every time he comes on. But check it out, listeners, FTSERussell.com. You have questions about the coronavirus and its impact on equities. A lot of you have questions about small caps, why they're so volatile, everything else. That's the place to go, that coronavirus hub alone A lot of great aggregation of data there you may want to check out. And Mr. Rhodes, if I'm looking at aggregating data, maybe I want to learn more about what you're writing up. Maybe it's somewhere else out, you're posting it. Let us know where we can find that. And then B, what is your vote on our poll? And then C, do you have a forgotten trading scene in a movie that we forgot you want to suggest, sir?
Well, probably the best place to find me is on the Twitter, and it's just my full name, at Russell Rhodes, spelled a little bit funny. Not like the sportscaster down in Tampa, Florida, who I get mistaken for every once in a while. And then B, that that my vote is for Quicksilver from 1986. Great soundtrack for Quicksilver. Lots of biking around San Francisco in Quicksilver. But I love that Ferris Bueller got brought up because I had forgotten about that one. So
I had completely forgotten about that too.
Should have been included.
I haven't watched Ferris Bueller probably since I was, maybe 10. So I need to go back and check. Certainly since I've lived in Chicago. It would have much more meaning to me now, I think.
Oh, yeah.
Than it did back then. But I've forgotten.
You need to bring that one bring that VHS tape back out.
Yeah.
And put it back in.
It's not like we don't have time to watch films from the 80s and educate my son about the 80s oeuvre, including Ferris Bueller's. I mean, all these plugs for Ferris Bueller makes me do want to go break that one out of the mothballs and check it out for yourselves. Meanwhile, you can check them out for yourselves, listeners. You want to see what Russell's working on? The best place, give him a follow on the old Twitters, at Russell Rhoads, 2 S's, 2 L's, and then Rhoads is RHOADS. He couldn't spell it any of the normal ways. What fun would that be? RHOADS. Give him a follow while you're out there. While you're following people named Russell on Twitter, give FTSE Russell a follow as well, at FTSE Russell out there. And I should give you an update here. What is winning? I think you probably expect it is indeed Trading Places, 71 and about 0.5%. Number 2, Rogue Trader, 12.2%. Number 3, Quicksilver, a forgotten gem. The movie isn't that good, but the scene where he wades into the crowd on like earnings day on the P Coast on a visitor's badge and starts slinging size. If you ever spent even 2 seconds in the trading crowd, you know how absurd that is, which makes it hilarious. So that alone probably gives it my vote, even though Trading Places, turn those machines back on. You gotta, that's iconic. I heard those words literally every single day when I was on the Seaboat, to the point where I would hate people who said it. But that is the name. That is the film. 71.5%. Other 7.1%. Ferris Bueller, a great suggestion. We'll have to include that in future ones. And on behalf of Mr. Sean and Mr. Rhodes and our friends over there at CME, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for sending in those questions, for listening live. Keep it all coming. We love you all. We're not done yet. We'll be back here tomorrow, 1 p.m. Central, 2 p.m. Eastern, to talk a lot about volatility. I have a feeling commodity vol is going to make it into that conversation as well. So if you want more conversations about USO and OIV and all that fun stuff, we'll get to that tomorrow. Volatility views. In the meantime, if you just subscribe to this show, just listening to this show live for the first time, make sure you check out our full network. We got 13 plus years of great content, over a dozen shows. You guys are going to love it. TheOptionsInsider.com is the place to go. Or just search for Options Insider on your podcast platform of choice. It's all there. Subscribe to the full network feed. That'll get you the whole kit and caboodle. We all have a lot of time on our hands right now. We're watching Ferris Bueller. Listen to a podcast or two. It'll help you out. And we'll see you back here again tomorrow for Volatility Views. And then Monday kicks all off again with the option block. And then we're back here again on Thursday for more of This Week in Futures Options.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.